Unfortunately, it's another ugly day in the equity markets. It's Friday, March the 6th, and this is Markets with Megan. If you like this podcast, subscribe, hit the alarm bell, share it with your friends, family, or colleagues. We're here to do these podcasts so that we can break down not only the economic data, but some of the things that are moving the markets on a regular basis. So today we want to start with a couple things. First is we got the February payroll report. This showed that the U.S. economy actually lost 92,000 jobs in the month of February. We also saw the unemployment rate rise to 4.4%. And no one wants to see this type of data come across the screen, especially when we're in the middle of a war with Iran, as well as just regular volatility in the equity markets. So it is impacting risk sentiment today, and we're seeing markets down significantly. But let's break through this report and just highlight a couple things. First of all, the unemployment rate was up due primarily to the U2 rate. This is a measure of those people that lost jobs during the month. That went from 2.05 to 2.12. So still relatively stable, but again, that did help boost up the unemployment rate. Now, on a positive note, let's look at this report as in the amount of disruptions that we had in the month of February. We saw a labor strike in Kaiser Permanente, so we did see the biggest drop in healthcare jobs in 5 years. We also had a lot of weather disruptions, so we saw a pretty sizable decrease in leisure and hospitality. And then don't forget, we're still shedding federal government jobs, so we did see that weakness there. So this is 1 month. We'll see if this noise that was related to weather and the labor strike, if that settles out when we get the March payroll report. But again, this is not something that the equity markets want to see on a day like today. Let's talk a little bit about what else is impacting the markets today. Kuwait did say that they're probably going to have to cut their energy production, not for any other reason except the fact that a lot of energy producers don't have a ton of storage out there. So when we're talking about the Strait of Hormuz, which we have highlighted is one of the biggest risks here, being shut down or disrupted, the energy producers don't have anywhere to store it. So they just end up having to cut back on output. So we're seeing crude oil rise to the highest level we've seen since 2023. It's about $88. And then gasoline prices have also shot up to a 2-year high at $3.32 for a regular gallon of gasoline. This is impacting not only Treasury yields that are moving higher because people are worried about inflation and what this will do to inflation. So it's not necessarily a risk sentiment flight to quality into Treasuries. You're seeing some selling of even some of those, the risk off type of investments like gold, for example. That is up slightly today, but it's down about 8% from its 52-week high. We're seeing the impact in the equity market primarily in, again, all of the indices are down from their 52-week high, but the biggest impact we've seen here because of this ongoing rise in energy prices has been in the small and mid-cap stocks, but growth stocks as well are really leading that, not only in the large cap space, but in the small and mid-cap space as well. They're down almost 10% from their 52-week high. That's because interest rates are higher, and these growth high PE type of sectors, they're getting hit. From an international perspective, we are seeing the Euro Stoxx 50, that's down about 8% from its 52-week high, and then emerging markets are approaching that 8% decline as well. We have highlighted that these types of geopolitical events historically have offered buying opportunities. So we are aggressively looking where there might be some opportunity. We had come into this conflict with very high valuations, so nothing was really attractive. We are seeing some discounts here in things like small and mid caps and then in emerging markets. So we're looking at this maybe being a buying opportunity. We're patient though as well. We don't want to overpay for anything because we don't necessarily know how long the war will continue, and we don't know what that impact will be on inflation. Even though the labor market report was weak today, I don't know that that brings the Fed to the table in March because of the fact that they already were worried about inflation, and what we're seeing right now is inflationary. That's all we have today. If you want a history of our podcast, you go to marketswithmegan.fm. Thank you.